Good evening, everyone, and welcome to today's Chinta Student Research presentation. We are delighted to have students from the Chinta AI Research Lab presenting the results of their work on Markov chains and stock market modeling. Today's presentation is titled Finding the Bounds of the Stagnant Zone in the Markov Chain for Stock Market Calculation, presented by Daksh Agarwal, Tarini, and Imad. So it's over to you guys. Hello? Hello?
Hello, I can't hear
Yeah,
you.
now, okay. Hello?
Hello.
Yeah, I think we are
Yeah.
audible. So, good evening, everyone, and welcome to today's Chinta Student Research presentation. We are delighted to have students from the Chinta AI Research Lab presenting the results of their work on Markov chains and stock market modeling. Today's presentation is titled Finding the Bounds of the Stagnant Zone in the Markov Chain for the Stock Market Calculation, presented by Daksh Agarwal, Tarini, and Imad. So it's over to you guys.
Yeah. Um, Good evening, everyone. Today I'll be presenting our work on Markov decision processes for quantitative trading. I'll be presenting the introduction section. Next slide, please. Which consists of the background, problem statement, related works, and our contribution. Next slide, please. Let me start with some background. Financial markets play a central role in allocating capital, and because of that, accurate modeling price movements becomes extremely important. One widely used modeling approach is the Markov chain, where stock movements are represented as transitions between states, such as upward, downward, or stagnant movements. Using historical data, we can estimate transition probabilities and construct transition matrices, which allow us to perform long-term forecasting using n-step transitions. Over time, this framework has expanded to more sophisticated models like hidden Markov models and reinforcement learning systems, especially for tasks like regime detection and sequential trading. Overall, quantitative trading relies heavily on statistical data driven methods rather than intuition or sentiment, which makes Markov decision models a natural fit for systemic trading. Next slide, please. On to our problem statement. First, most studies define market states using arbitrary fixed percentage thresholds, like 0.5%. These thresholds fail to account for asset-specific volatility. A 0.5% move for a stable stock is meaningful, but for a volatile stock, it's completely insignificant. Secondly, poor threshold design makes stagnant or middle state transitions extremely rare, and it also groups minor and major movements together, reducing the overall predictive accuracy. Thirdly, traditional Markov models rarely incorporate sequential decision making, which is essential for real trading, where we must decide when to buy, hold, or sell. To address these issues, our work aims to identify empirically optimized thresholds that maximize profitability and accuracy, and to extend Markov models into Markov decision processes, linking state transitions directly with decisions under uncertainty. Next slide, please. Um, we examined the most relevant related works. Several studies, such as those by Bhusal and Shrestha and by Choji and Eduno, use Markov chain models to model market regimes and long-term trends. Others, like Oiteno and all, apply simple three-stage Markov models for forecasting. However, some studies incorporate techniques using fixed thresholds. For example, Aronson and Lindbergh use a plus minus 0.5% without volatility justification. Boyan and Chen use extremely narrow plus minus 0.03 bands. Okonko and Adiola use quartiles but still lack adaptability. And Sharma and Patel again relied on the same plus minus 0.5% thresholds. Finally, studies like Sun and all highlight that reinforcement learning requires a solid Markov decision processes uh, for, formulation, emphasizing the importance of linking regime modeling with actual trading options. Um, Onto my contributions. Our work makes four more main contributions. Firstly, we introduce data-driven threshold selection methods that significantly improve both profitability and accuracy. Secondly, instead of relying on arbitrary fixed percentages, we define thresholds based on statistically justified and market-specific characteristics. Thirdly, we integrate Markov chains with Markov decision processes, creating a unified framework where transitions guide optimal trading actions like buying, holding, or selling. Finally, our method remains interpretable and adaptable. Unlike black box deep learning reinforcement learning models, this makes it more robust and suitable for real world quantitative trading. Thank you. On to Daksh.
Next slide, please. And next slide again. Thank you. So now I'll be taking you through the technical foundation for a paper, how we have structured our data, and what methods we have used to find optimal thresholds. Next slide, please. Next slide. Yeah. So for understanding this, we need to talk about some notations. Some of these notations are the closing price, which is signified as PT. Then we have got the daily returns, which are recognized as RT. The RT is represented as a function of PT, which is difference between PTs of 2 days and dividing it by the previous day and taking this all in a percentage formulation. Then we have got a return sequence. The return sequence starts from the second day, basically R2, and goes on till Rn, which encloses and comprises of all the returns that we have. The state is a very important function in our research. This is what we are trying to predict. And each ST is classified into one of three categories. State 0, also known as bear. This is when the returns are less than theta d being our lower threshold. The state 1, which is the stagnant one, is when the returns are between theta d and theta u, with theta u being the upper threshold for our research. The state 2 is the bull, in which the theta u is less than the returns for the day. Then we have got transition probability matrix, which is constructed using these states. We have a very simple formula for this, which counts the number of days in which the transition I leads to the transition J. And then this is taken as a percentage of all the transitions from that particular state to any other particular state. Then we have got two very important margins or two very important calculations on which we refer with if our model is good or it's not. It's the accuracy and the cumulative returns. The accuracy is being the days, the percentage of days in which our model predicts the state perfectly, and the cumulative returns being the total returns that we have got. Next slide, please. Our data comes from Yahoo Finance, which daily adjusts close prices for 97 companies across three sectors: finance, gaming, and sports. The companies which had insufficient historical data were excluded from the analysis, and some missing values were filled through forward filling. It is very important that we did not do any form of detrending in our research, because we believe that the trends in the stock markets are essential to the research, and taking that away would only be data tampering. That is why we want the data to reflect reality and not a smooth version of reality, which had led to the decision that no detrending should be done. Next slide, please. The data partition is a very important part of our research, which in a way prevents cheating by the system in itself. We have two different methods by which our research was done, one being the grid search methods, which is also method B, the statistical methods, also known as method A. Both of these were divided in three separate areas and two separate areas, respectively. In the first one, the grid search methods, three separate areas were created. The 64% of the data was taken as the training data. 16% of the data was taken as the validation data, and the 20% was taken as the final performance evaluation for our data. In statistical methods, we have only gotten two different regions, which being the 80% for the observations and the 20% for the final evaluations. Next slide, please. Here is a small model on how the Markov chain methods work. Basically, the Markov chains is such a project or a mathematical function that predicts the state of the next day solely based on the previous day. And using this, we have used the functions theta d and theta u. The threshold framework, as we can see here through our tree, is divided into two areas as discussed previously. Those are then broken or redistributed into four and two different methods respectively. I will discuss them in the forward slides. Next slide, please. The statistical method uses distribution of daily returns into four different regions: the area to length, the exponential medians, the exponential midpoint optimization, and the mean plus minus standard deviation methods. I will be discussing them henceforth. Next slide, please. Here is the histogram area to length ratios. The histogram area to length ratios is a very beautiful method, which basically takes the area income priced between any two randomly chosen thresholds and then divides it upon the length of the threshold. Let us assume we have got two arbitrary thresholds, one T1 and T2. So what it does is it takes the area that is income priced between the two regions in the histogram of the returns throughout our 80% of the data, and then it divides it by the difference between the two thresholds. What our methods does is it finds the two values for which this function is maximized, and those values are determined or taken as the theta d and the theta u. Next slide, please. The exponential median is another very beautiful method. It basically assumes that our graph is an exponential graph. It takes the best fitting exponential graph to our histogram. We do understand that an exponential graph is by no means a very good fit for the model, but it turns out to be a very good fit when it comes to finding out the thresholds, which we will later show when we will go for the experiments and the results. Can we go to the next slide, please? The exponential midpoint optimization is another brother to the exponential median method. It works on the same principles, but this time it marks the midpoints rather than the medians as the thresholds, which can be seen over here through these formulas. One thing to be very wary about is that we take these two exponent, we do not take the whole histogram as being part of one exponential. In fact, we take the 0 point as a line and draw two exponentials along the positive and the negative axis respectively. Next slide, please. The mean standard deviation technically takes the median for all the data in the histogram and finds out the standard deviation. It takes the positive standard deviation as the positive threshold and the negative standard deviation from the mean as the negative threshold. It works on this simple principle. Can we go to the next slide, please? These are some statistical diagrams which show these four methods being worked on arbitrary data. These the places we have shown this data are not our histograms, but simple general natural states in which these statistical measurements are usually found. Next slide, please. The performance optimization grid takes 100 different pairs, that is, from the theta d's possibility from 0.00 to 0.09, technically 0.1 percentage, 0.2 percentage, and so on till 0.9 percentage. Similarly, it does the same for the positive thresholds. Now, our model simply takes the 64% of the data that we had previously mentioned and uses the Markov chains to create a model for it. Then it tests this on the validation part. After this, we have two different measures which we will talk about later in this discussion, and based on it, it selects the best thresholds out of all the threshold groups we have found. and then that threshold is later tested upon in the testing region of the 20% of the data. Next slide, please. Hence, we can see that we have done the optimization on the basis of two criteria: the trading profitability and the accuracy. We have done this in two different methods because we understand that our model is not a standalone trading optimization or a trader, and it is in fact a clamp that can be added into other models to make their trading methods better. Therefore, they could use the user, whoever uses our model in their research or so on, could use this as a clamp for either returns or the accuracy. And henceforth, we decided to study on both these details. Next slide, please. And now I'll be handing over the mic to Tarini, who will be discussing the experiments and the results for our project.
Thank you, Daksh. The experiments and results were also similarly divided into method group A and method group B. Method group A being the statistical methods. Next slide, please. Beginning with method group A, the focus was mainly on evaluating the four statistical approaches for defining thresholds in the Markov chain state transitions. This method relied on tools in Python such as NumPy, SciPy, Pandas, and Matplotlib. Exponential parameters were estimated using nonlinear curve fitting, and transition matrices were constructed directly from categorized return sequences. The entire analysis across all companies was run under 5 minutes. Next slide, please. Results showed that histogram thresholds were stable but often struggled when results were skewed, which was the case in many distributions. On the other hand, exponential fit approaches produced better profitability and sharp ratios or accuracy. Specifically, method 3, which was the area to length exponential optimization that used midpoints. This consistently performed the best across all companies. Next slide, please. This graph shows a plot between the profits for the 30 energy companies these statistical thresholding methods were tested on, and the Sharpe ratio of these 30 companies. It also shows that the yellow plots, which are method 3, showed the highest profits and proportional Sharpe ratios, which is positive. Next slide, please. This table also further emphasizes the success of method 3, as overall 30 companies it gave the highest mean revenues and the second highest mean Sharpe ratio. Next slide, please. Compared to traditional fixed threshold Markov models, uh, this framework for method A resulted in significant improvements without heavy computational cost. And specifically, method A3, as I had mentioned earlier, performed well, outperforming more static thresholding approaches. Method group A demonstrated that incorporating the empirical return distribution into threshold decisions improve predictive performance, as thresholds are company specific instead of fixed. Finally, the train and test split of the data prevented look ahead biases. Next slide, please. Now, moving on to method group B. First, the experimental framework. Method group B expanded our evaluation of adaptive thresholds to 97 companies across the gaming, finance, and sports sectors. Each company had 399 days of returns in its that were calculated, and this was split into three sections: training, validation, and testing, as mentioned by Daksh before, to avoid look ahead bias again. A grid search was conducted over 100 asymmetric threshold pairs, and this was done on the trained data. And the goal was to find the thresholds that maximized returns. Next slide, please. Our most important result is that the optimal thresholds varied dramatically across companies. Uniform thresholds were in general found to be less effective, especially in comparison to thresholds found through method B's grid search method. And in most cases, these adaptive thresholds outperformed fixed baselines that have previously been used. According to the experimental results from Method B, 80.4% of companies using trading strategies that were based on adaptive thresholds showed significantly better performance. A few finance companies with narrower optimal thresholds achieved 23.01% higher returns compared to their fixed threshold performance. This directly contradicts the common practice of applying the standard plus minus 0.5% universal thresholds for the no change state. Next slide, please. This table shows the data of the top 5 performing companies from Method B using adaptive grid search methods. And the columns show company tickers, cumulative returns, Sharpe ratios, win rates, and optimized thresholds. In all of these cases, the different companies selected different thresholds to maximize profits, again showing that these were more ideal than the fixed thresholds. Next slide, please. Another insight from the study is that each sector favored different interval ranges. The finance sector favored narrower optimal thresholds, while in contrast, the gaming sector required wider thresholds. The sports sector thresholds were somewhere in between, and this confirms that each industry has a different range of optimum thresholds as well, depending on volatility and market conditions. The use of these optimal thresholds in the finance sector was the most successful, showing mean Sharpe ratios of 4.07 and mean cumulative returns of 16.5%. Next slide, please. To summarize the results of Method B, company specific thresholds are required as they consistently outperform fixed thresholding methods. Optimal thresholds varied widely across companies and sectors, as shown before, and this further discourages the use of fixed thresholds across sectors for the construction of Markov chain transition matrices. Next slide, please. Our experiments showed that adaptive company specific thresholds outperform fixed thresholds in Markov chain stock modeling. And these thresholds varied widely across companies due to differences in market volatility, as mentioned before. Um, Adapting to these differences improved both the profitability across industries and the risk adjusted performance. This challenges long-standing assumptions in financial modeling and suggests that future work should focus more on flexible, data-driven threshold selection strategies. Several promising avenues remain for extending this work. One direction is to explore continuous threshold optimization methods that go beyond discrete grid search, potentially improving efficiency and precision. Another is to integrate the statistical thresholding methods into reinforcement learning, also known as RL models. Extending the framework into intraday data, multi-state and multi-asset portfolios would also allow us to test the robustness of adaptive thresholds in higher frequency market conditions. And future research could also involve investigating how these thresholds would perform under regime shifting market conditions, which would improve their applicability in real world trading scenarios. I hope you enjoyed our presentation. Thank you.
Thank you so much, Daksh, Tarini, and Imad, for this wonderful presentation. So, like, if you have any question regarding the presentation, or if you have any question to our presenters, you can put your comment in the comment section. We will be really happy to respond. Okay. Thank you so much all for joining the session.